What's going on, everybody? Michael Silva here. You're watching the Stock Market Brief Show. This is the weekly recap episode. Timestamps are going to be in the description below. We have a lot to talk about because, well, it was a very interesting week to say the least. We had Fed members coming out, Kaplan and Rosengren. They're talking about selling their stocks into cash and index funds, because they made multi-million-dollar trades in 2020. So they're selling them out for ethical reasons, ethic concerns, which is crazy to me because we're at all-time highs just about, maybe a few points off. And then we also had Brian Deasy, the guy from the National Economic Council, let us all know that if we remove beef, pork, poultry from the inflation data, well, the food prices, which that's all he was talking about, was just the food portion of it, aren't that bad. If you just take out what people like to eat, it's not all too bad. What do you know? Oh my gosh, we got a lot to talk about. If you're new here, welcome to the channel. We use technical analysis and intermarket analysis to get a good idea as to where the market might be headed next. And we got to keep a close eye on that dollar. I'll get into that in the dollar section, but let's hop into today's show. All right, peeps, welcome back. We're going to look at the market dashboard. Let's see how the week performed. Everything in the red. Holy moly. Real estate took the biggest hit, but I mean, okay, it also took the biggest rip the previous week, or just about there. Same with healthcare. Okay, so those weeks, they're seeing a little bit of a pullback. The ones that performed the best of the worst, I guess you can say, because everything finished in the red, was consumer discretionary and the financial sector, which consumer discretionary is interesting to me still at this point. It's being held up by like 3 stocks, Amazon, Tesla, Home Depot, I think it is. Don't quote me on that, but I'm pretty sure those are the big top 3 in consumer discretionary that make up a large percentage of it. But if you take a look at the volume advance decline percent line, this is a cumulative line right here. What's interesting to me is this. The XLY is chugging higher. Meanwhile, the volume advance decline line here has been just heading south. There is clearly a divergence taking place. And the reason why consumer discretionary has been just kind of chugging up is because of a very few select stocks. So what happens if all of a sudden they get weak? Well, then you're going to see this move down significantly faster if the big dogs can't hold it up. And you can see here that the majority of the stocks in consumer discretionary, well, they haven't been doing all too well. Okay, so it's either going to resolve in price to the downside or it's going to resolve throughout time. We just need to be very mindful of that going on. We saw some price action that was relatively, obviously, weak this last week. And if you watch the previous weekly episode, I mean, we kind of just nailed on the head right there, mapping out some key levels. So let's go into this portion of the dashboard. We're looking at relative strength, rotating sectors. There's 11 sectors that make up the S&P 500. It's okay if you don't know all of them. Let's just point out a couple things taking place here, okay? First off, utilities is gaining some momentum here these last 4 weeks in the improving, and it's one of the only that are going from the bottom left to the top right. So when you see this kind of tail like that, first off, to note, utilities is defensive, and if defensive sectors start performing stronger than the S&P 500, it's typically a little bit of a red flag. It's nothing to get overly too concerned about, but it's something to pay attention to. The ones that have been performing better than the S&P 500 the last 4 weeks of trading is technology and healthcare. Those are the 2 leading ones, but you can see they're kind of curling themselves out as of right now. Retail has been weakening. Materials is trying to turn up here too as well. Oh, what was that? Control V. Oh, wait, no controls. Oh, no, my gosh, what's going on? Oh, my gosh. Whatever. We'll leave it. You can still see it. Where was I? XLB. Material sector is getting some strength, trying to improve here too as well. You want to focus really on the stuff that's on the right-hand side of the screen. That means that they're performing better than the S&P 500, so they have that relative strength. So that's right now it's communication services, XLC, right? It's XLRE, it's XLK, and it's XLV, but you can see that they're starting to try to rotate out here. Meanwhile, the defensive names, right? So consumer staples, XLP, hasn't done anything. These last 4 weeks, down 0.9. It hasn't even budged. All right, and utilities is starting, you can see these dots start to expand towards this where we are currently, and that means it's picking up some momentum here. Now, we did have a weak in utilities. We were down 1.5% for the week in utilities. So it's something to monitor, something to watch. The last trading day, it was very weak. It was probably the worst performing sector. So just a lot of stuff going on here. Let's hop into the S&P 500. So first off, we're going to go from weekly to daily to 15-minute, map out some key levels. Something to note here on the weekly time frame, we closed below the weekly 5 EMA. When we close below the weekly 5 EMA, are we going to see more continued selling? Well, we haven't actually had a weekly close. Okay, we haven't had a weekly close below the weekly 5 EMA for how long here? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 weeks. So quite some time. 11 weeks we haven't closed down there. So, what happened when we did close down below it? Well, we immediately recovered and we headed higher. So it's something to pay attention to. We'll get into other time frames to map out some key levels. If you take a look at the daily time frame, Coco keeps barking in the background. Coco, come here. S&P 500 on the daily time frame. This could be a rising wedge structure. Clearly, I want to pay closer attention to the lower trend line. The lower trend line has been tagged. So clearly, it's coiling up. You can see the base, and then it's getting tighter and tighter and tighter and tighter. It's going to break one way or another eventually. It has not done so yet. What I will pay attention to is, you could draw this out a couple of ways here, but still 440 on the S&P 500 is still going to be an area of support. So maybe we get a crackdown through it, but I'm not sold that that's the beginning of the end or anything like that. It's been tagging the 50-day moving average and being bought up. So what do you do in this case? So you can see here, 50 period, or where are we at? 50 period, tagged it, moved higher. 50 period, moved a little bit lower, tagged, moved higher, 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 tagged, moved higher. And now we're pulling down into the 50-day moving average. Yeah, perhaps we get a little bit extended past it. Perhaps we don't even hit it at all. Okay? But what are the chances of getting a bounce from that level? Well, they're greater than it completely just getting deteriorated and falling. Okay, the chances are you can take a good risk to reward trade by going long right at around the 50-day moving average if it can get down there. So around 440. Okay, the 50-day moving average is at 441, 443, 441.50, let's call it. But the lower Bollinger Band is right below there, and then we had that round 440 number. And even down to 435 where this previous candle was, okay? We can always bounce from those specific levels. So, when you come down here, sorry, where was the 50-day? So when it was coming down here, it would have made a great trade. It came down here, made great trade. Right here, great trade, great trade, great trade, great trade. So it's eventually going to break at some point. Is that going to be now or later? You need to kind of determine that for yourself. But history suggests that we'll probably bounce from that level again. And if that's the case, you want to at least be hedged long. You don't want to just short into the 50-day moving average. That's, by the way, inclining, okay? You can short into the 50-day moving average if it wasn't so just strong right here. And then you look at the other moving averages, 200, 100, they're also sloping up. So like I said, there's always that possibility, right? Maybe that Hindenburg omen indicator that signaled is going to be the end of the world here, but it's still within this structure. It still hasn't been confirmed below the 50-day moving average or a couple of days closing below it. So there's nothing to really actually worry about. What you should be focusing on is if we do continue this rally higher, as some economists and some people are saying that this is going to be some crazy melt up, you at least want to be prepared for something like that, but then manage your risk effectively, because if we are wrong, you don't want to lose a lot of money. But how much money are you really going to lose if you start picking up, accumulating shares, either of the S&P 500 or stocks within it at 440 when SPY hits 440, and you have a stop loss below the 100-day moving average, or maybe even just below that, and you just take stabs at it? Like, how much are you going to really lose? Well, I'll tell you one thing: you're not going to lose as much as freaking it coming from September down this much on a 10% correction if you're managing your risk correctly. Okay, 15-minute time frame. I'm getting carried away. We broke through that 447 level. So this was an area that I was watching very closely. Well, we pulled into 447. It acted as support. That was that bounce. But guess what? We put in a lower high, and then we cracked down through it, dead cat bounce, and now we're heading lower. This is what you want to pay attention to heading into next week. First off, if we get a gap down, I would be a little hesitant with a gap down to start shorting into that. I would actually personally look into finding long positions because we're already oversold. Okay, RSI, getting that oversold, pretty frothy to the downside. Yes, PMO, the momentum has been declining here for quite some time. Maybe perhaps it comes down to -3, but we have a gap right here. This gap in the volume shelf profile can act as a level of support. That's right at around 443 to 444. So if we get a gap down through that, the RSI indicator is going to be extremely oversold, and that could produce one heck of a rally. Not to say that it's going to go to all-time highs by any means, but it's something to pay attention to. Now, if we get a gap up, I'm going to say, okay, if you're looking to short, okay, if you're looking to short into this, you want to follow the 5-day moving average, okay? This is on the 15-minute time frame. You put in the 130-day moving average, but this is actually just the 5-day moving average. And you can see here it acted as support. Support, when it broke, it acted as resistance, 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 and now it's heading lower. So perhaps we bounce back into that. Cool trade. And then we start heading lower. Manage those, be tactical in this environment because it is very uncertain. We have all kinds of weird stuff going on. Russell 2000, weekly time frame. We closed below the weekly 5 EMA. That's to note. The small caps can't get out of their own way. It's right here in the middle of this channel that it's been trading in. Look at the Bollinger Bands. They're tightly contracted. Contraction can lead to expansion. Okay, so when things get contracted, they can then expand. That doesn't mean to the upside. That doesn't mean to the downside. That means that it can expand either direction, so we need to be prepared for what direction that is. As it stands right now, price has been going nowhere for basically almost all of 2021 since February, okay? And now the Bollinger Bands are getting contracted. We're in the middle of this channel. Let's look at the daily time frame so you can get a better idea. We're sitting right at the 50-day moving average, the 20-day, the 100-day, and the 200 is below us. So as of right now, price needs to hold above the 200-day moving average if you're a bull. If you're a bear, look for the crack below 210 on the daily time frame. But you got to always pay attention to how price gets to that level. So, for example, this right here, this candle is a big red candle. We gapped up and we came down. So basically, we opened at the high and we closed at the low. This is a very bearish candle. Okay? So, if we get some big, massive red candle that opens up right here and then comes straight down in a single day down to 210, you don't want to short that. I mean, you want to short maybe intraday. But let me show you what happens if you get this big rubber band stretched out candle like here. Well, you get, and then look at a gap down, right? And we say be careful about those gap downs. You get these rubber band snapbacks. Okay? So just be mindful of a big solid red candle to the downside. People are going to be frigging out, right? I'm not saying that that's going to happen, but it just, you don't, people chase, okay? Retail traders chase. All right, so when they see this big, strong move up to here, you see people start buying up here. And then guess what happens with all those buyers up here? Well, you get the other people that are the pros selling into that, okay? That's where supply is. So you get plenty of supply up here at 230 to 235. So much supply, and then demand comes back into play right at around 210, okay? More demand here, demand. And what you can do as a trader, if you're looking at this as a channel, right now, there's not a good setup. In my opinion, there's not a good setup. It can go either way. That's how I see it right here. Price percent oscillator looks like it's half the bearish crossover. It's above 0. So my guess is that we can still head lower, obviously, but that doesn't mean that we can't just bounce right back from 210. Or this could be potentially a bull flag where we just get some sort of crazy gap up and then rip up higher. And this was just a shakeout day. Okay? It's anybody's ball game here in the Russell 2000. But if the other indices continue to press higher and higher, they're going to need the help of small caps sometime. at some point, small caps are going to have to resolve to the upside if the market wants to continue pressing higher. And something to pay very close attention to within small caps is the financials. So if financials do well, 20% of the IWM is financials. And then you got to look at energy too. So energy has to perform, financials have to perform, because that makes up a big portion of the Russell 2000. Okay, so if energy continues to be that lagger that we're looking at here, and it's been lagging on the price action, and if financials continue to just get weaker, I mean, they're starting to try to turn up here, but they're still in the weakening category, underperforming the S&P 500. Why do you think that it is that price action hasn't gone anywhere for a long time? It's because of all of that. All right, now let's look into the 15-minute time frame. I was looking at this. I'm like trying to focus on some levels and how, where can we potentially look for longs or potentially shorts. A couple things to notice. We broke down through this rough drawing of a UFO spaceship. Okay, head and shoulder pattern, left shoulder head, right shoulder we cracked down, and then we back tested it and we started heading lower. This, to me, a full measured move would take us to right at around 216. So we're already overextended to the downside. Okay, so if we get some crazy gap down, like up to around this level, I would be buying into that. If we get a crazy gap down, is that going to happen? I don't know. If we get a gap up, I'm going to be looking for the 5-day moving average as a level of resistance heading down. You can see high, lower high, lower high, lower high, lower high. So right now the short-term trend is down, and the longer-term trend, looking at the weekly and the daily, is neutral. So that would be technically more bearish here in this category until certain levels can get recovered. Okay, let's go to the Dow Jones. And just so you know those levels, it's like 216 to 218. So it's a range here. The support zone is 217. The reason why it acted as support here, then resistance, and then the price cash market session. Okay, this is cash market, not after hours. It couldn't break this level. So aftermarket, the futures, we gapped right through it, acted as support, and we started heading higher, and we haven't tested that level since. Okay, so perhaps a back test of that level can act as support, and sometimes we get gap fills too. Excuse me, hiccuping or burping. I gotta take a sip of my drink. All right, Dow Jones. I'm already running later than usual on this, but that's okay. Dow Jones weekly time frame. This is a very bearish week. Down 2.1% for the week. Whoa, where did we fall? Right on the 20-day moving average. Okay, so price came right down to there. Last time it was there, we bounced. Last time it was there, we bounced. Last time it was there, well, it was a little bit more scarier, but we still recovered and we bounced. So price action on the weekly time frame. The wind is at our back if you're long. Why? The PMO on the weekly time frame. Bearish crossover, yeah, it's above zero. But by going long while we have the wind at our back, just know that it's going to be more choppy conditions. And well, what have we been seeing? More choppy conditions. Okay, so that's why I like to look at the PMO on the weekly time frame. If this comes down on the weekly time frame, where it can be an area of support? 335. Now, this is the Dow Jones Industrial ETF. Okay, so I don't know what that means for the industrials, the index. I think that's 33,500, 35,000. I don't even know. Okay, 33,500. I would imagine to be right around that range. But I like to look at the ETFs because sometimes I trade these. All right, so 335 on the weekly time frame would be somewhere to note, somewhere to watch out for. Okay, let's look at the daily time frame. Daily time frame overextended to the downside. Why do I believe that? Well, because we're a couple deviations out from the Bollinger Band, right? So the Bollinger Band, 20-day moving average is in the middle. Then we have two standard deviations outside of that, and we're closed below that. Now, this could be the start of a potential squeeze, and Bollinger Band squeezes can go up or they can go down. So I'm looking at key levels of support to where we could potentially bounce from. Okay, so first thing to note is we cracked right down below this guy. Okay, so that's taking out that level. That's bearish. However, from a bullish perspective, so first off, let me note, we have a high, and then we have a lower high. We have a low, we have a lower low. How does this change now? Well, we need a cracked above to pretty much all-time highs to change this. And then we have to move back down and create a higher low than this. But as it stands right now, this could be the start of a bearish trend. Maybe. But when you look at support levels, when you look at the trend, you look at the moving averages, okay? 50-day, we crushed through that, okay? So, all right, it's still inclining though. Still going from bottom left to top right. 100-day. Have not cracked through that. That's going still trading up. And then the 200-day is clearly trading up too as well. There's a good spread between the two. So this is something to watch. We had support here, support here, support here. Perhaps it acts as support again. This is a big red candle. Big red candle. When rubber bands get stretched out, you can have snapbacks. Okay, so if, like I said, if you get these gap downs, be mindful of that. Could be the start of something big, yeah, but you could also be the start of a great opportunity to go long. We don't know. We don't predict. Technical analysis does not predict where price is going. Technical analysis allows you to set up quality risk versus reward setups. That's what it does. And as I see it right here, it's still within this construct, still within this technical pattern, still within a bullish trend. And we're seeing some weakness based off of really, honestly, who knows what. It could be a countless, unlimited amount of things as to why, why the market should be lower than where it is right now. Okay, 15-minute time frame could be a very tight falling wedge pattern to watch. If we break out of this, look for the 5-day declining moving average to act as a level of resistance. The RSI also oversold. So we're getting, you can see now, we're getting a lot of oversold things because of how the price action closed up on Friday, which is weird to see the price action close like this on a Friday. Let's just get that out there, right? Typically you get the VIX Crush Friday, and the VIX Crush Friday means the market goes higher. This is actually very similar to what happened pre-COVID crash, right? If you actually pull up a chart and you look at, let's just say the NASDAQ 100 or the S&P 500, I believe, on Friday, we had, it was at all-time highs a few days before, and then all of a sudden, we had this, spike in the VIX, and we'll get into the volatility indexes here soon. Why do I think that this could potentially bounce from this level? Previous support right here at around 346.50. Strong move to the downside. That's a rubber band stretching out, can snap back. We break out of this. Doesn't mean that it's going to go to all-time highs. That's not what I'm saying. But what I'm saying is you don't short here. You can get lucky. Yes, you can get lucky, obviously. But I don't know. Let's just say if the market opens up same place. Okay. You don't want to short there. Now, if we get some sort of crazy gap up, I just actually would be careful. I wouldn't even really short into that just because of previous times that's happened. As markets pull into these, key levels of support and we get these bounces back up, they typically get follow through. If I'm going long, I want to see the market just get crushed in the morning. A big gap down, rip a little bit lower, and then I want to try to just throw in a couple tags. Good risk to reward tactical trades, because if we do start seeing some increased selling or the market goes all crazy like we saw during COVID and you get all these market halts, yeah, be a little careful there. So as long as you can manage trade, manage your risk units, you're going to be fine. NASDAQ 100, this is one of the only that did not close. This is the Qs. Closed below the weekly 5 EMA. However, it is a pretty bearish engulfing candle right here. Not like crazy. Like this right here is a bullish engulfing candle, and that was a very strong signal, right? Because we gapped pretty significantly down. We came straight up. We traded sideways, and then we broke out of that range. So if this gets some continued follow through to the downside, we still have support right at around 367, 365. We'll get into that. But as it stands right now, technology, the Qs, is above the weekly 5 EMA. Yes, it's a bearish looking candle, but we don't have the follow through yet. So if we start cracking down below that, then be a little hesitant, especially if you're watching the bonds and if the TNX, right, the 10-year yield, if it starts rising at a rapid rate of change, it's going to put pressure on the megas, the mega techs. Now, from a daily perspective, I drew out this channel. Okay, I drew out a channel, negative divergence. Can we head lower? Obviously, the 50-day moving average is going to be right at around 370. That can act as a level of support. 370 would also match with his prior resistance right here. So we broke out of that range. We come back to test it, and we're still within this channel. Watch this channel as time continues, right? The PMO looks like it's about to have a bearish crossover. Clearly a negative divergence there too. Momentum slowing, right? But it's overall in still a bullish trend. So if it come way down, if we get some crazy moves to the downside, start looking at it right around here, you know, the 100-day or even right here, around 350 as an area to potentially buy some dips from, all right? If you're watching this channel. Now, another thing to note is sometimes if you trade channels, you can technically short from the top into the middle and take profits, and you can buy long in the lower range, and you could take profits back into the middle of the range. So it's just range trading is what I was going for there, not trend trading, range trading. So here's the cues on the 15-minute time frame. We cracked through this basically doing nothing sort of multiple days since August 30th. We've been going nowhere for multiple days, and we finally cracked down. To make sure that this is a real crackdown, what you want to see is a test back up, and it acts as resistance. Where will resistance be? Start looking at 379 as an area of resistance. Okay, if we can hold that, the 5-day moving average is going to start to decline here, and then that can act as a level of resistance as well. We're already oversold. Last time we were oversold, it was right here, and we bounced, right? So if we get that gap down into this 374, 375, that can act as an area of support. Maybe we rally up higher. Everyone's like, everything's fine. And then you start watching to see it act as resistance right at around 379. If we gap right back up within this, well, then we're back. We're just back within that little channel. Nothing much going on, right? You can just see here the PMO on the 15-minute time frame. This has been just declining momentum for quite some time, and it's in bearish context below zero. Let's look at some stock market indicators. This is one that I shared on Twitter prior to it actually taking place. But if you take the trend on the hourly time frame and you overlay the 10-day moving average, the 10-period moving average on day, so basically it's looking at 10 hours. When we reach this red line, the market gets a little shaky. So we reached it here, market sold off, but we recovered. Reached it right here, market sold off, but we recovered. Here, same thing, here, same thing, here, same thing. A little very short one, and then right here. And then what do you know? We tagged the level, so it got a little shaky. And we're starting to see that happen. So if you look at this indicator, when can you get bullish? Well, typically if it reaches up this higher range. So when it reaches these levels, like it did here, pow, to the upside. Right here, pow, to the upside. It got reversed, but it's still headed higher. Right here, boom, pow, to the upside. Right here, pow, to the upside. All right, so that's something to watch. It's not the holy grail. Nothing's the holy grail, but it's just something to note that if you do use this indicator, you can watch those two areas for, you know, it's the contrarian trade. Things are either way too bullish or they're way too bearish. So when things are way too technically bullish of a reading, you want to get a little bearish. And when things are, excuse me, too bearish, like they were here when it got extended, that's when you kind of want to go bullish. And you can see the price came way back down and then boom. The NYSE Advanced Decline Volume line, back below the 200-day moving average, back below the lower Bollinger Band, still below the 50 RSI, big negative divergence there. That's not the greatest, I'll be honest. We saw the same thing here. This is just a big like, what's going on? And I can tell you what's going on. It's just there's been, you know, the megas, the FANG stocks, right? We don't need to go through them all. They've been holding the market up. The NYMOT, we talked about this last week. We were saying it was getting overextended to the upside. When it gets up to those levels, it can act, and we could see a sell-off. When we get to this minus 300 levels, well, we can bounce. It doesn't even need to be minus 300, actually. It could be up minus 200. That's been an area of support. So right now we're at minus 75. We hit this level, and we started selling off there on the NYSE. New York Stock Exchange. Look at this volatility. These two patterns we were watching, the falling wedge, guess what? We broke out, we consolidated, we plow right to the upside. The last hour of trading, look at this. Boom, boom, boom. Up to 21 on volatility. Holy moly. Is this the start of something bigger, or is this just one of those episodic and non-trending things that Keith McCullough always says over at Hedge Eye? Well, you know, it's Too tough to determine, but we can look at other time frames to help us determine what to watch for. So first off, the weekly time frame, guess where we're at? This is interesting. This is where it gets kind of crazy, right? We're at the upper Bollinger Band. The upper Bollinger Band can act as resistance. Then we're in the confluence area of resistance where it's been tightly held in this pattern. But, so to me personally, maybe perhaps we do push up to 25. But this to me is getting a little bit overextended. Doesn't mean that it can't break out, right? But so far, if you were buying and going long certain equities or certain things at this upper range or even at the upper Bollinger Band, you've been doing really good. All right, so the history of these last 2 years, if that was the case, or a year and a half, that's the move to make, is to go long, not short the market. However, the Bollinger Band's very tightly contracted, and we're right at the cusp of a potentially Bollinger Band squeeze. And you could see a falling wedge breakout could take us plow to 80. I don't know about that high, but it could, right? So a couple areas to watch is the 25 level and the 40 level. That's where my eyes are going to be. Let's take a look at the VXN. This is the NASDAQ vol. Still shows like it has a little bit more room to go here too as well. But just big red candle. We were watching that, positive divergence taking place on the last episode. It was the price action was going lower, but the RSI was kind of upticking. We'll plow right up to the upside, but we're still within this technical pattern. So if it goes up a little bit higher, just up into this area, and you don't think that we're going to see this breakout right now, well, okay. Well, then you'd want to start looking for long positions in potential some NASDAQ 100 plays. Russell vol. This is right here also at the upper range. Bollinger Bands were tightly contracted. Perhaps the start of a Bollinger Band squeeze, but we haven't got that technical breakout of this yet. Now, RSI is getting above 50, and it's not there frequently. Last time we were there above 50, though, those ended up being good buying opportunities. All right, so it's confusing. It's a difficult time. Maybe we need to see what the price action wants to do before you start firing off shots. Here's the XVG, the Value Line Geometric Index. This has been a negative divergence for quite some time. And now we're closed back below the 50-day moving average. It's been acting as resistance. And it's a strong possibility we come tag this lower trend line here and see if that breaks or if it continues to move back up. So we'll watch that. But other than that, the S&P 500 still remains above its 50-day moving average. So there is still a divergence here as this was at all-time highs, and this has not cracked through an all-time high here since June. Crazy. Now, transports, this could be the linchpin in the economy. Transports are going down. This is that indicator telling us, okay, maybe the economy is not as great as it sounds, as people are cracking it up to be, right? If you follow Dow theory, you watch the industrials and then you watch transports. We've been talking about this negative divergence taking place. And now industrials are seeing the worst performance out of these other indices, and it's back below the 50-day moving average. The transports are back below the 50-day moving average, and we kind of cleared this channel, right? It acted as support, and then we just broke down through it. So transports, if they don't start recovering and they just continue to press lower or sideways and head, it's going to be very, very hard for the industrials or the Dow Jones Composite to start performing without the help of transports, and that is not a good sign. So look at the BP NDX. This is the bullish percent index. This helps me find overbought and oversold territories to, just signal, certain buy signals or sell signals. I was paying attention to these structures because these structures were leading into the same months. And we talked about it before it really hit it, and it acted as resistance again. So I'm watching for the potential breakdown or break out of one of these. I will say that the RSI, it's right there just below 50, so it's not overextended to the downside or the upside yet. There's not much going on here as it stands, but we'll be keeping a close eye on it. The BP SPX still has a little bit of room to go, but remember, if we get down to these levels, you typically look for long positions. So if we do get a gap down, that could potentially force this to head lower, and if that is the case, well, we might be even more overextended, which we discussed on the S&P 500 area, where you can look for a long setup. All right, something to note though, sometimes breakdowns take place when it gets overextended as well. So it still goes without saying, you need to manage risk. Okay, you don't want to go all in on anything. You want to be tactical. If tactical to you is going all in, well, good luck with that. Commodities, oil. Oil has been doing nothing really at all. I mean, it's been compressing between the 50-day and the 20-day moving average. Probably going to get set to move in either direction with some force here very soon. If you scale out, if you zoom out, let me see if I actually have the weekly time frame. I do. If you zoom out on the weekly time frame, look at, we were closing below the weekly 5 EMA, but look at, we got bid right back up. We closed above the previous week, so we're up on the week. We closed above this candle and that candle. So that's actually a good sign. It doesn't look like it much on this time frame. It's been compressed, but if we start getting above 70, that could set us up for a pretty gnarly move here in crude oil or light crude oil. We're right there at the 20-day moving average on the inclining weekly 5 EMA. The PMO, the wind's at our back right here, but who knows if this starts curling slowly over, and that could shoot us right back up to around 77.50, our previous all-time high. What does that mean? Well, I would expect financials to follow suit. I would expect energy sector like XLE or energy stocks to follow suit. So if you like trading energy stocks, start looking for setups that might be consolidating or coiling up to potentially break out here if oil wants to start moving higher. Now, if we crack below the low of this week, 67.50, just slightly below that, then it means it's not doing much for us. Take a look at gold really quickly. Gold, it's not doing anything. It's just range bound. We got to get above 1840. Thought that we were going to get there. Sold off completely. Bollinger Bands, they are contracting. Contraction can lead to expansion. That could be to the downside, right? Contracted here, expanded to the downside. Contracted here, expanded to the downside. Contracting here? I don't know. PMO, take a look at that. About to have a bearish crossover. And we're right there near zero, so that's pretty bearish to take place. Last time that happened, we did head lower. But that quick move to the downside ended up being a great buying opportunity if you've been watching my other gold episodes. Let's take a look at silver, potentially forming a bear flag. That's something to watch closely, to say the least. If we start cracking down through that, as we're already below all these main moving averages, that can get bearish and bring us right back down to this 22.50 range. But still, price of silver hasn't really gone anywhere yet. Copper is another story. Copper saw a lot of strength here this previous trading day with a lot of volume, broke out of this bull flag, reclaimed the 100-day moving average. RSI is shooting back up. It's a very strong move for copper as the PMO is trying to get back through zero, so this is one to watch. We need to get above 460. If that's the case, that could be setting us up for a pretty strong move for copper miners and just copper. Now, corn. Now I'm going to go into a couple soft commodities. Corn, on the weekly time frame, there's obviously still more downside. I had a long position on a pop, and then I ended up getting out of the position because it just looked like it didn't look like I was going to get any follow through. So I got out in good timing, but this week we formed a little bit of a hammer candle. So that's going to be one to watch. If we start getting back above the weekly 5 EMA, which is declining, then that could be some signal of strength. But right now it's consolidating sideways, not moving much, and we're at the lower end range of this. And you can see as it's pulling back down into the lower Bollinger Band, the volume has been kind of drying up here, but the price hasn't really gone too far. So this is actually pretty bullish, right? If you look at this big pull here moving up, now it's consolidating, digesting those gains, form a little bit of a hammer candle. Last time we were down at these ranges, we saw some pops. So, does that mean it's going to be breaking out here? Absolutely not. Actually, it's in more bearish context because of where we stand to the 5 EMA and the 20 EMA, but it is still consolidating and coiling up tighter. If you take a look at soybeans, a very similar story here. You have the trend line, tag, and every time you tag it, it bounces from those levels. But you can see this range expansion is now contracting, and contractions can lead to expansions. And if that is the case, if we break out to the upside, you want to wait for confirmation. That can take us a whole new leg higher. It can take us back to this all-time high and just above that. But if we break down, it can take us back down to 18, right? And you can see here, very similar structure with the volume, on the move up. Pow, this move, you can see volume increasing, and then it's been consolidating sideways. Volume's been drying up. So when volume starts to pick up, look for that to be more confirmation of a solid move. So if we get confirmation break to the upside with strong volume, we can get some follow through. Same thing goes to the downside. And just so you know, that's how you set up trades. You can be bearish this and set up a quality trade, or you can be bullish. So what would you do? Well, you buy a breakout on good volume, then you have a stop loss down here. if that's the case. Or if it starts breaking down, well, you have a stop loss up here and you can short if you like to short the market. Let's look at uranium. Uranium has been it's been all about uranium. Just holy moly. Very strong move in uranium. Why am I showing you the rate of change down here? Well, the rate at which something changes, that momentum burst, you can call it a burst of momentum, chances are you get follow through. Doesn't mean that this is a good area to buy, which, by the way, I am going to be launching my interview with Amir Adnani. He runs Uranium Energy Corp and got some really good insight that I'm excited to share with you. But notice this momentum burst here, 2020, right? That was on a pullback, but momentum burst, let's say May, bam. It consolidated, but we had that follow through. Bam, momentum burst, then it started kind of tapering off, but you can see we had follow through. Okay? Now we're starting to get this big burst. Price action's moving up. Doesn't mean it's the greatest area to purchase it, but if we get a pullback, then start looking for buying opportunities. You want to buy into this strong momentum, but you don't want to buy at the high. You want to find a good area. This is URA. There's other uranium stocks or other ways you can invest in uranium, but I would be looking, okay, if we do get a pullback, 23, that's previous resistance. We're breaking out of that. Even if you look at the monthly time frame, it looks darn good if you're a longer term investor. As far as a shorter term trader, I don't like chasing, and I feel like that move was missed. But there's going to be opportunities, either consolidations or pullbacks that you can look for. Let's take a look at the dollar. The dollar is going to be, like I said, the linchpin in most of this stuff. It's either going to like help us out, it's going to hurt the markets. So the dollar, we talked about this in last week's episode. We said what? A lot of strength to the downside. However, this lower wick into areas of support. Perhaps we bounce from that level. And if we bounce from that level, that's going to send what down? Well, it can send equities down and even other commodities. And what do you know? We bounce from that level. The market started selling off. This is acting potentially. This trend break was acting as an area of resistance. Is the dollar going to continue to break down? Many very smart, intelligent people are saying that the dollar will continue to move down. But there's also a lot of smart and very intelligent people that say that the dollar will probably get squeezed higher at some point before it really sells off. It's like you can find anything to fit your narrative these days. If you think it's going to go down, you can go online. You'll find reasons why it's going to go down. If you think it's going to go up, well, you're going to find reasons why people think it's going to go up. You've got to just follow price. Price is going to let you know. You can't follow one person's narrative. If you follow one narrative, right, the market's not made up of that one person. The market's made up of buyers and sellers and even algorithms that do the same thing, buying and selling, but people program them, all right? And then the market moves, ebbs, flows, and you get to visually see what the market is doing. All right, if you look at the weekly time frame, we broke out an inverse head and shoulders and we started to crack down below it, but then it started to recover. Still sketchy material, but the RSI is still kind of heading up, and this area right up here is still acting as an area of resistance right around 93.50. This is where it gets interesting. It's still the monthly time frame. First off to note, the monthly time frame is starting to look like a hammer candle right now. The month isn't over. It's not even close to being over. It's September 11th right now. Okay, so we still have a lot more time left. The monthly 5 EMA is inclining, so that's bullish, short-term bullish, right? And then we have the PMO doing this bullish crossover taking place. It's below zero, but it is bullish crossover. Last time we had that, we rallied higher. Right here, plow, we rallied higher. That was 2014, 2013, leading into 2014. That was a taper tantrum, I believe where that was. Bullish crossover right here, pow, higher. Here, pow, higher. Here, pow, higher. We broke this trend line, head and shoulders, okay? Broke the trend line. We haven't back tested it yet. Doesn't mean we have to. But with the bullish crossover, this right here, there's a strong possibility that if we head higher, we'll go and back test this trend line. The Bollinger Band will be heading lower at that same time. So if that is the case and we see the dollar get pressed from 92 to 96 or 98, and the rate at which it changes, that will put pressure on the equity market, that will put pressure on commodities. Definitely commodities, okay? So that is something to watch very closely, is the dollar. Let's look at bonds and yields. TLT, this looked like it was going to break out that day. It did not break out that day. I know that there's a lot of economic data that came out. I'm not going to get into that. Why? You don't need to be an economic forecaster. All you need to do is watch the bond market where all the professionals hide out at. And then determine, right now, it's not going anywhere. It's consolidating. It was range expansion, and now it is contracting. When it breaks, be prepared. Yeah, it could be a fake breakout, a false breakout. It could do all of that. But if you're setting up trades, you need to set up trades in accordance to, if you play technicals, to these technical structures, if you're a technical trader. If you're a macro trader, which I am not a macro trader, good luck. I mean, a lot of macro people build out theses, and then they create the portfolio, and then that's it. They wait, right? And they hit huge hits, or they're completely wrong. But typically what you want to do is, if you're wrong about your thesis, you still want to be able to make money. All right, so that's what differs these really intelligent people from just everyday retail traders. If their strategy is wrong, it just means that they don't make as much money. But if it's right, they make a lot more money. All right, so start thinking in terms of, okay, if I am wrong, what can I do to still potentially make money, right, in this market? So right now it's contracting, it's coiling up. Right here was an inside trading day on Friday, a little bit down. If you take a look at the TLT on the weekly time frame, this is where it gets interesting, folks. We're closed where? Right at the weekly 5 EMA. Slightly below it, right? So 148.52 is the weekly 5 EMA, and we close at 148.40, just below it. Talk about just crazy how we just pull right into it. So this is interesting to me because of this. We're below that, but if you look at the TNX, actually, let's bring up the TNX on the weekly time frame. It was below the weekly 5 EMA as the weekly 5 EMA is inclining, and it closed above it. It's the highest close since mid-July. Actually, even more than that, since early July. Okay? That's not necessarily a bearish thing, and if the TNX wants to start pressing higher here, and this PMO, which wins at our back right now, not at our back, wins at our face. I've been saying that wrong, right? To have wind at our back, this needs to be obviously, we'd be long, and then it would be trading like this. I've been saying that wrong, my bad. So we had the bearish crossover here in June. That means if you're long, you're going long to go for price action to go higher, but yet wind's blowing at your face. My bad. Somebody call me out. So yes, on the daily time frame or the weekly time frame for the TNX, if that doesn't start changing, well, guess what? Yields can press higher, and the rate at which they change could put a lot of pressure on like big tech. And then the daily time frame is still within this technical bearish flag, short-term bull channel, but it's coming down from a pull of price action heading down. And you got the 100-day sloping down. We're still right there around the 200-day moving average. We're back above the 20. It's not anywhere. It hasn't gone anywhere for multiple months here. It's the same place that it was in July. So right now, not much going on. But if we do press higher or quick hit, start looking at this 1.4 or 14.5 on the TNX as an area of resistance, okay? Let's get into Bitcoin now. So Bitcoin, the sell signal, right? If you watch that, maybe not. The sell signal was triggered. We were having a pretty significant sell-off in the price of Bitcoin. However, what does that mean? That doesn't mean, okay, it's up to you what you want to mean, for it to mean. But in the strategy that I put together, the strategy just says, okay, the week closed below the zero line, so the sell signal, it's not a false signal. But that doesn't mean just sell all your stuff. It means put a stop loss, give it some room right below the low of the week. The low was, what was the low? You're going to have to look that up because I don't have the price action. It's below 45, but above 40. 42,500. I don't really know. You'd have to pull the price action up. 45,201 is where it was at right here. So 45, 44, 43. I don't know. I'm not going to guess. So if you look up the weekly time frame, wherever the week closed off, you'd have a stop loss below that. And if it gets triggered, okay, then you're out of your position. But the last buy signal, you're still up significantly. Okay? So awesome there. Now what do we do? Well, if you get stopped out and the price action, they're like, but what if it keeps heading higher? Well, then the buy signal is going to get triggered. And if the buy signal is triggered, then you would be entering back in. So it's as simple as that. The last time we had a sell signal, it kept on heading lower and lower. And this, a lot of people are saying that, price, oh my gosh, narrative follows price. Okay? People are saying the reason why this happened is because of the El Salvador thing and XYZ or this and that. But the price action was literally setting itself up. If you looked at the rate of change and you looked at other different asset classes and you're paying attention, you can see that the price action between Bitcoin and gold was getting strength relative to the price of Bitcoin. And that's not a good sign, because typically what we've been seeing is Bitcoin is always rising faster at a faster rate than the price of Bitcoin. And if you're paying attention to gold is right, I forget, I don't know what I just said there. But what we've been noticing was, and why I posted on August 30th, was it was starting to head lower, and it looked as if it was approaching the sell signal. And when it did approach it and when it did trigger it, guess what? We then saw the move. So we knew that prior. Now, it's not like we tagged it perfectly, and you can never tag anything perfectly, because the price action, when I call it out, actually headed higher, and then it reversed. It ended up playing out. And no, this isn't no holy grail. So don't think that it is a holy grail. It could go wrong. The more and more people that know about it, chances are it's going to become more relevant. But as it stands right now, it's been pretty darn good at spotting trends here in Bitcoin. Now, if you just look at the daily time frame and you don't want to pay attention to that, I think that 42,000 is an area of support. It acted as resistance here, resistance here, resistance here, and when resistance is broken, it then can become a level of support. Okay, so watch that level as a potential area of support if you just want to look at the price action. But if this starts cracking down 44,000, there's no reason why I can't go test 42,000. Maybe we bounce again. Does that mean it's going to put us on a buy signal? Maybe, maybe not. I don't know yet. Okay, we got to watch. Well, I'm just going to continue to watch that kind of indicator. As it stands right now, my position is still long, and I'm still up in it. Okay, I'm not going to let those profits go to waste, especially if the price starts declining significantly on me. That's all I got for you, everybody, on today's episode. Holy moly, we talked a lot. Just to wrap up things, yes, we saw the price action selling off. Okay, pay close attention to the dollar in the next week of trading, the month of trading, right? I'm looking at this from a longer time frame. Look at these technical constructs. The S&P 500 still in bullish context. Okay, and then all those main levels that we've been watching here on the 15-minute time frames too. Some very interesting stuff taking place. But don't miss out on opportunities because of narratives that you might be feeding yourself. You want to follow the price, and the price is still bullish at this particular point in time. So you look for setups at areas of support. And so far on the S&Ps, it's been the 50-day moving average. And if I'm wrong, or if you end up being wrong, you put protection in place to make sure that you don't get destroyed. But as it stands right now, the markets just continue to press higher. That's all I got for you, everybody. See you later.